Welcome to Sampo TV. We are already closing the book on 2025. It's been a hard year for investors. That's why today we invited a true expert for 2026. Our guest spent more than 3 decades in Wall Street, most recently served as CIO of New York Life Investment Management, responsible for over $800 billion. Let's welcome Jae. It's such a privilege to have you again.
Thank you. Nice to see you again.
Forgive me for saying this, but your face seems much brighter compared to 4 months ago. Is it related to $800 billion no longer resting on your shoulders?
No, I think it's related to no more company politics.
So speaking of your change, you've started a new venture. What's the new title?
It's not a new venture. I am still in transit, or I'm still in search of what I want to do.
Mm-hmm.
But in the meantime, I actually started a small, in America, you create an LLC.
Oh.
So I created a small company LLC so I can do advisory role. I'm on a board in Korea. I'm looking to add myself to a board in the US.
Mm.
So if you do these things in America, you create your own little company. So that's what that is.
So let's start with reviewing 2025. One of the year's biggest one word would be gold. I was watching the surge, and while I was watching, it suddenly got me confused because I thought gold was safe haven asset.
Yeah.
But this year it felt more like a high stakes trade.
Yeah.
Are the old rules for gold now broken? What's your perspective?
Yeah. So gold, even crypto, to some extent had a purpose, and the purpose evolved to something else. It's because of the momentum trade, right? So if you've actually heard me speak along the last bunch of years, I was a gold bug back right before COVID, actually. So around 1450 about gold, trade out of it around 2500 when it broke back to 2000, bought it again, traded out of it around 3200. And now it's, hit 42, and I missed that last run. And I missed it because, I'm the kind of investor, I like to look at valuation. And this year, many assets, including, tech and a lot of these assets, Bitcoin, it's a very momentum-driven market. And so value-centric people, Warren Buffett, Jae Yoon, whatever, these types of people are going to miss this complete runaway train. So gold, since middle of the year, has become a runaway asset, what I call momentum stock. So, an example of that is I was moderating a panel recently with 2 ETF CIOs. So they're more of a product people because thematic ETFs don't really have a view. They're just, you have a stylistic tilt and then it's passively managed. And these 2 gentlemen were pushing a concept of diversify your investing by owning tech stocks and gold. Then you're very well diversified. I have to say I was a little bit shocked because it is not diversification to buy AI and gold.
Mm-hmm.
It's very much all in on momentum. Right. So I think gold, when it started to break above 37, 38, some of us on Wall Street, technicians and such, I'm not a technician, thought this would actually start to have a bit of a correction, healthy correction. Forget correction. I think that's when a lot of investors, retail especially, decided they just got to own it. And so if you look at 20-day moving average, which is very volatile, or it moves very quickly, gold moved so fast, it left the 20-day moving average behind. So it just shot up. So when at 4,200 last Wednesday, it started to break down, it seems obvious after the fact that, of course, it will. But until, with a runaway or bubble in the making, once it runs away, you just don't know when it's going to break. But chances are it will have to break. And it broke. So I think for gold, it's still quite above 20-day moving average. So again, I'm not a technician, but if you listen to kind of these technical reading, once its momentum broke, it probably will remain broken. So I think last couple of days we have a situation where momentum broke on gold. We have perhaps rally in equities resume as we look at possibly Santa Claus rally this year, which is highly likely now at this point. Now, gold is going back to your question, it's a safe haven. But what else is gold now? So it's geopolitical risk, which is part of safe haven. It's inflation hedge.
Yeah.
And don't forget, we have a possibility of inflation. Not right now, but as we look at next 2 to 3 years. And then it's also the last bit that people don't recognize yet, or people start to recognize, is it's a trade against U.S. control. So, for example, the BRIC countries, China, Russia, India, and Brazil, other BRIC countries, or BRIC countries representing countries that have a not great relationship with the U.S., they've been shying away from buying treasuries and buying gold.
Yeah, they have.
Because what they saw is Russia started a war with Ukraine, and then right away U.S. decided, okay, we're going to sanction and lock up all the Russian money that might be in U.S. banking system. But Russia, in preparation for the war 3 years ago, bought gold and crypto. China's building up their gold reserve. India, these are countries that are not very much in good relationship with the U.S. And also, there is Bitcoin and gold are both what we call in the fiat currency trade.
Oh.
All these governments in developed countries are issuing bonds and spending money they don't have. Eventually, anybody who fears the fiat currency, which is the current currency system, to fail, will own Bitcoin and gold.
Okay. So then let's talk about the here and now.
Yeah.
Gold is finally taking a breather after this massive run, like you said. For everyone who felt this missed the boat on gold, is this the second chance to jump in, or would this be a slight trap for them?
Yeah, no, I think gold will do well. Will central banks continue to buy gold? Yes. Central banks don't go in and out. Once they start getting in an accumulation mode where they're adding, they'll add multi-year. In China, India, they will continue to add. Retail investors in China and India love gold. They just love gold. So that trend is going to be multi-year. Inflation concerns are multi-year. So I think gold is fine, longer term. But how much will it correct and where should it be? Don't forget, when gold was 14, 15, I thought it was 24. When it was 24, 22 corrected, I bought it and I said maybe we'll see 3,000. A lot of people thought I was nutty. And then when it broke to 3,200, I sold it. People thought I was crazy too, because why would you sell it? It's going up. So a lot of investors love to just chase momentum. Gold has a very difficult valuation because its valuation is not very clear. However, I think gold in the long run, as long as inflation does come back, and I think we're going to be looking at multi-year 3% type of inflation, so gold probably should have good value.
If you're seeing gold in the long term good and positive, why is it going down so much?
Too many people bought it too quickly. So when I sold gold, I should also add, I actually bought platinum, white gold, right? And that took off. So don't forget, you don't just have to look at gold. In fact, this year, silver outperformed gold. Platinum caught up and outperformed gold for the year, right? Even though gold's had a great 5-year run, silver missed out and platinum missed out, and they actually have a catch-up rally this year. So I actually play those two. I think in the next bunch of years, 3 to 5, if inflation is going to remain sticky at 3%, nothing drastic, then broader commodity should all do fine, not just gold.
Oh.
Yeah.
Gold wasn't the only massive story of 2025.
Yeah.
The other, of course, was AI.
Yeah, sure.
And paradoxically, the market feels almost too strong. AI companies are reporting fantastic earnings.
Yeah.
The 3 major US indexes are hitting all-time high.
Yeah.
But it's this good news that's making me more nervous and anxious, giving a too good to be true feeling for me. Do you think it's a healthy skepticism, or is the market's perfection itself the biggest warning sign?
Yeah, these days, many things are bucketed under AI. So to say AI trade is very hard to be specific, right? You have the traditional cloud computing, you have semiconductor, you have some energy companies that like nuclear, etc., which is getting a AI bug, because as data centers get built, the traditional energy may not be sufficient. So we're back to needing potentially, quite a bit of energy source. That includes nuclear. So nuclear, uranium ETF, which we owned and recommended, ours has doubled, but I think on average they're up like 70% year to date. So what is AI? We'll just need to be more specific. However, AI infrastructure is very real, right? We know that. But how sustainable is it long run? It's not clear. In the next 12 months, so the Amazons of the world, right?
Yeah.
These big hyperscalers, that we call them that. There was a report out this week. They are spending 60, some say 70% of their free cash flow, money they make, on AI development. So when you're spending almost all the money you make, you and I have an income. If we're taking 70% of our income and spending it, that means this thing better work. Mm-hmm. Now, it will work, I'm sure, for some of them. All I'm saying is not all 5, 6, 7 players that are competing with this level of spending will be successful. We know, as we saw Google take 90% of market share, leave Microsoft with some. Yahoo used to be a big player, by the way. Before Google, Yahoo was the dominant player in 90s. They've gone away. I think you have Yahoo Weather and Yahoo Finance left, but Yahoo is a search engine. Nobody uses that, right? So in this sense, the 5, 6, 7 players can all win. We know that. But they all know that they can't afford not to be a winner, because you will die. So in this sense, is AI very real? Yes. Can they afford can they afford to save some money and not spend 70% of their free cash flow? No, because if they lose this race, they're done. So in this regard, at some point in the next 2-3 years, you will probably see an exhaustion, right? Not all the data centers will be needed potentially when the winner is defined. Or maybe you can refurbish and reuse it. Maybe the winner can use it all. But I think right now, there isn't enough data center, there isn't enough chip, there isn't, in 2 to 3 years, there won't be enough energy. So yes, for now we have to keep building. But at some point we will find, we'll have some redundant capacity, and that's when things are going to look wonky or a little challenging.
So AI rally has clearly expanded to memory, semiconductors, and even the energy sectors in every areas. The market now seems to be searching, so what's next?
Sure.
Kathy Wood did an interview with Pro TV. She seems to be focusing on AI-driven biotech as well.
Yeah.
What's your view on this?
To me, I've started to accumulate biotech healthcare sector because they've been pretty badly, or they've underperformed meaningfully. They've never participated in this recent rally for the last 2-3 years. If anything, some biotech stocks are down in the last 3 years, despite equity markets have done so well. So coming into this year, I actually wanted to move away from AI, or U.S. tech, but I moved to Japan, China. Within U.S., I moved to. I had healthy financial stock allocation. They've run up a lot, so then I've shifted to healthcare, biotech, recently REITs. I've even picked up staples because they've just been so badly beat. Now, staple may not be the most exciting thing I would necessarily recommend. It's a little bit of a, instead of parking money in cash, I'd rather get some dividend. I even bought Coca-Cola, right?
Oh.
Cash is less interesting. So staple is a proxy for cash for me. Pays healthy dividend. You get a little bit of low beta upside. Okay. So in this regard, healthcare is definitely, and biotech is definitely going to benefit from Fed cutting. Cheap. REITs, same thing. Fed cutting, you'll benefit. Interest rates coming down, borrowing cost. And then it's been unloved. So like I said, I think in the next 2 to 3 years, if we find that inflation will remain persistent, second half of the year we have economy slowing a bit. And I don't mean like corporate earnings, which has been resilient. I mean the U.S. economy has slowed a bit, broader economy. And in this regard, excuse me, inflation continues to remain modest. You know, it's stuck at 3% or slightly below. And I think in the next 3 to 5 years, it will go above 3 and may hopefully won't run too hot, but it will remain persistently above 3% unexpectedly. And in this world, I would venture you want to own stocks. You want to own assets that help you fight inflation. That's stocks, that's commodity broadly, all commodities, frankly, and it will not be bonds, right? Because you go back to the 70s and you look at asset allocation. When inflation surprises on the upside, meaning you don't expect it, but it comes in stronger than your expectation, then stocks and commodity go up, bonds go down. And I think next 3 years you have to expect inflation will start persistently coming in higher. In the U.S. anyway.
If the inflation gets much more higher, what would be the next step for Fed?
Then they can't cut as much. So at end of the year, anybody who then expects a further Fed cut, Fed has not committed to any more cut after that. That doesn't mean they won't cut, but after that, they're going to spend more time worried about is inflation going to hook back up. If that happens, they're probably done. So when we get to 3.5 Fed fund rate, we're going to be asking ourselves, should we head toward 3 or should we pause here?
So for investors whose portfolios are now heavily weighted towards AI or gold, thanks to this year's surge, what's the right move now? So is this the right time to rebalance and take some chips off the table, or do you see this as a let your winners run this environment, holding firm into 2026?
Yeah, everybody's got to have their own rules, and you should stay disciplined. Generally, you should rebalance often. Okay.
I don't rebalance.
At all?
Yeah.
Okay. Well, you should.
I should do it.
Well, you should. I mean, you shouldn't do a rebalance just because you feel the market's gone too far. But you should have a systematic way of rebalancing with certain frequency. Let's go with certain frequency.
That's why I'm here to learn.
No. You know, some people can rebalance once a year, etc., or quarterly. Big institutions rebalance quarterly, right? Just as a rule. Maybe more frequently, less frequently, but that's kind of the general rule of thumb. I think you should rebalance generally with certain discipline frequency.
Okay. So the winners are afraid of losing their profits, but there's another group facing perhaps an even more painful fear.
Fear of missing out? Yeah.
Yes, fear of missing out. Many investors watch this rally from the sidelines, and is it too late for them to get in, or should I join the rally even at this high price?
A lot of people talk about U.S. market from the bottom of May at S&P, 4,900. But don't forget, S&P started the year at 6,100, 6,200. If you look at year-to-date performance at index level, not individual stocks perhaps, China, K-Web or Internet outperformed the U.S., NASDAQ. Japan, I think recently started to finally run up. It was doing fine, and then it finally had a little extra kick. Now outperforming S&P. So I think the trade to move out of the U.S. did just fine, but a lot of people get excited about U.S. stocks off of the bottom, where it corrected 20% and then rallied subsequently like 40%. Okay, and then let's see. Even within the U.S., financials did just as well, or may have even beaten, because it didn't correct as much. So all I'm saying is you don't just need to own AI stock to win.
Oh.
But of course, AI stock's so volatile. If you can pick, and if you are really that good at selling at the highs and buying at the bottom within a, Tesla's been up and down, up and down. If you're that good of a trader, by all means, pick the most volatile thing that you can find and try to pick the top and bottom. But if you're just generally looking at, gradually getting in and out of stuff, I think the right trade is not to put any more money in the AI trade, but to possibly look at other sectors. Yeah.
Jae, it was a true pleasure. Thank you for your time today.